what's the problem with magic money? Dollars themselves are magic money. And I mean, I've thought for years and years and years, if they're lying about inflation, if they're lying about unemployment, if they're, everything that we get is a lie, then why would even the amount of debt outstanding be real? Why would money supply be real? I mean, we're lied to on everything. So they need to go to cash. They need to support and strengthen their balance sheets. The only way to do that is to put real money that cannot default, and that's gold.
Similarly, an increase in concerns over the trajectory of U.S. government debt could drive central banks with large U.S. Treasury reserves to buy more gold, as well as drive speculative positioning and ETF flows higher, which could provide an additional 5% rise in prices by the end of the year, bringing them to $3,250. Global gold mining production grows at approximately 1.5% annually, while demand continues to increase from multiple sectors, including investment, central bank reserves, technology, and jewelry. This favorable supply-demand ratio supports long-term price appreciation. Precious metals expert Bill Holter emphasizes that gold is not just a commodity but real money. He questions official financial data, arguing that if inflation and unemployment figures are false, so are money supply and debt numbers. While the US dollar may seem strong against other fiat currencies, he warns this is just measuring crap versus crap, as all fiat devalues against gold. A higher price for gold does not tell us anything about gold. Gold's higher price over time reflects the loss of purchasing power in the US dollar. The US dollar has lost approximately 75% of its purchasing power since 1980. This means it costs about 4 times as much today for comparable goods and services as in 1980. For the gold price to fully reflect the loss in US dollars purchasing power, it would need to be $3,460 per ounce today. From a technical perspective, Holter predicts gold's steady rise is driven by big money, including central banks seeking stability. Central bank buying has fueled gold's rally in recent years. As countries like China continue to push for de-dollarization or wean themselves off the world's reserve currency, it likely serves as a massive tailwind for the metal. The US dollar has weakened recently, making gold cheaper for foreign buyers since the metal's price is quoted in greenbacks. On the topic of stagflation, Holter mentions that there is no doubt it is already taking hold. He argues that financialization has overtaken the real economy, leading to a looming crisis. Now, we present the clips of Bill Holter's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I would just caution you not to lump gold in as a commodity. Gold is money. It's traded on the exchange as a commodity, but it is money. And if you go back literally, hundreds and hundreds of years, whenever it looks like we're headed into a bear market or bad times, the best thing to have always done is go to cash. And back in the old days, cash was gold. Cash was silver. Today, cash is trash. It's fiat currency, first off. And if you're looking at a money market, it's short-term debt. If you're looking at bank deposits, that goes against loans. Cash is not what it once was. So I think that's what you're seeing, especially in gold, tractor in first gear move that we've seen over the last, quite a few months now, of going straight up, no huge spikes, not really huge volatility, but just a first gear grind. That is a function of big money. When I say big money, I'm including central banks all over the world, knowing what we're talking about right now, that they need to go to cash. They need to support and strengthen their balance sheets. The only way to do that is to put real money that cannot default, and that's gold. So, and to answer your stagflation question, yeah, I think there's no question we're going to have stagflation. You could look at commercial real estate is already imploded. If you're in Washington, D.C., and you own a home, is it recession or is it already depression? Nobody can sell anything. That's all of this is because everything is financialized. It's a morph into the financial system and create a crisis. Now, in a crisis, the dollar itself is not going to strengthen. It might strengthen versus the pound or the euro or the yen, the USDX, but that's measuring crap versus crap. When you measure fiat currencies versus real money gold, that tells you they are devaluing like crazy. inflation. There's no question we're going to have inflation. At the same time, we have deflation of assets. It's what I've said for 15 years now, that we would have inflation of the things you need and deflation of the things you already have.
While reflecting on fundamentals, Bill Holter argues that modern monetary systems make war easier by enabling limitless borrowing. He sees the strikes on Yemen as a pretext for war with Iran, pushed by war hawks, including Israel. He also criticizes restrictions on free speech about Israel as a First Amendment threat. Gold has been considered a safe haven asset during geopolitical and economic uncertainty. The ongoing Israel-Gaza conflict could drive oil prices higher, which may negatively impact investor sentiment in emerging markets like India. Rising oil prices can contribute to inflation and slow economic growth, prompting investors to shift funds from riskier assets such as Indian equities to safer alternatives like gold. Gold prices have surged 14 times since Donald Trump took office in January, driven by economic concerns from his trade war. Meanwhile, a weaker US dollar, hovering near a 4-month low, has made gold more attractive to foreign buyers. UBS and ANZ have adjusted their forecasts, targeting $3,200 per ounce, citing ongoing geopolitical issues and economic policies as catalysts for further price increases. Moving forward, Holter warns that tariffs slow trade, reduce cash flow, and threaten highly leveraged financial markets. Since everything relies on credit, an economic crash could halt the real economy. Let's get back to the interview.
Yeah, first off, I don't think the stance of war is an exogenous event. If you think about it, it's so much easier to wage war with a monetary system the way we have today, where they can just borrow or print the money. I mean, if you go back 100 years ago, 200 years ago, in order to wage war, you had to have some gold. You had to have money. You couldn't borrow. You couldn't borrow your way through. And I mean, what's going on in the bombing of the Houthis? It's my opinion that the war hawks want to attack Iran, and I mean I'm including Israel being a war hawk. And I mean, all you have to do is look at Trump's stance on Israel. He's already written a executive order about anti-Semitism. If you say anything bad about Israel, people are getting kicked out of school. You can go to jail. And I mean, that basically just destroys the First Amendment. So it's my opinion that these strikes on Yemen and making the statement that if anything else is done from them, it'll be viewed as coming from Iran. I personally believe they want to attack Iran. And obviously Israel would love that. Yeah, and understand, and I'm just going to use the term tariff broadly, because of the tariffs with Canada and tariffs all over the world. Understand that tariffs, what they do, they slow trade down. They don't stop trade, but they slow it down, which means there's less cash flow generated from the real economy. The danger is that the tariffs slash the angry dealing, if you will, spills over to the financial markets. Financial markets are so leveraged at this point that you could pick almost any, and they don't even have to be big. You could pick almost any type of real economy event that could easily spill over to the financial markets. And the financial markets, because they've been walking a tightrope of too much debt. And now if you throw tariffs in, that slows the cash flow down. You add Doge into it, that obviously slows the cash flow down. And what happens is the Ponzi scheme no longer has new money coming into it. So the danger is that the real world affects the financial world, and the financial world just completely blows up. And when that happens, then the real world stops, because everything runs on credit. There's nothing that you will do, touch, use, see today that doesn't have credit involved, except looking at your lawn growing or trees growing. Everything that you do, credit has already been involved in it to get it to that point in space, in time.
An improving global economic outlook could significantly diminish gold's appeal as a safe haven asset. If trade tensions ease and growth metrics strengthen, investor capital might rotate away from defensive positions in gold toward more growth-oriented assets like equities. Do you think central banks will continue increasing their gold reserves, or will the US dollar eventually lose its global reserve currency status? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.